name is Matt Gerardo, and welcome to Icarus Footwear's conference call.
Hi, I'm Lisa Jansen, Chief Operating Officer of Icarus, and I'll be going over our initial competitive strategies. At first, we wanted to avoid making an extreme move in the beginning as we waited to see what our competitors would do. We decided to start with a mid-range value product because we thought it would be less risky to start off with. We also wanted to focus more on the high-growth potential areas such as the Asia-Pacific market with less focus in the already developed markets. We wanted to push into private label because there was more growth potential thought to be there. We also wanted to control costs, so we wanted to avoid tariffs by having a North America plant produce for both North America and Latin American. We donated 1% of our profits to charity in order to have a CSR initiative and to boost brand image. For financing needs, we decided to take out short-term loans so that we could repay them back quickly and keep our credit rating high. We implemented competitive tactics which were in alignment with our strategy, so we focused on pushing towards an SQ rating of about 7 to 8. Again, we decided to control costs by avoiding tariffs and increasing productivity in existing plants, making plant upgrades as needed. We offered many models with average support and delivery times, and we priced slightly above market average in alignment with our SQ rating. Our goals for financial performance were to have an ROE of 15% in year 14, stock price of just above 39, and grow revenue and profit 7%. Unfortunately, we experienced some issues in our early years. We began with a scorecard score of 77, which was mid-performance. However, we had a major issue in year 12 with poor bids in private label and issues in production leading to major losses. Now Jared will talk about the factors accounting for our shortfall.
Looking at the factors that accounted for our shortfall, I think that early on we focused too much on the Asia-Pacific market and the private label market, and we didn't anticipate the competitive demand that was going to exist for the private label production and wholesale production in the Asia-Pacific market, and so ultimately that primary strategy became infeasible. And early on, we increased our investments in plants too early and too rapidly in an effort to implement that strategy. And when it didn't quite pan out for us, we were stuck with some higher fixed costs, which crippled our ability to recover from losing the private label bid. And now we have all this excess capacity and couldn't fill it. So another reason I think we missed our projections was because we over-relied on the projections from BSG. I think that diverted our focus away from making strategic decisions and shifted our focus to more tactical moves. We spent too much time trying to optimize BSG's projected outcomes. When we would make decisions, we would make sure that maximized our operating margin or our revenue growth or our net profit growth, and we didn't stay focused on the strategy. And overall, that hurt us early on. So we realized as a team we needed to get together and reformulate a new strategy. And with that, I'm going to pass it on to Matt, who's going to discuss our new corporate strategy.
So after falling into last place and having some difficulties early on, we decided to change our corporate strategy and our competitive strategy. Our new corporate strategy was to exit the European and African market where we had negative earnings. Another move was to exit the private label where we were hurt substantially in the second round when we failed to get a private label bid. We just thought there was too much risk involved with this segment. Our new competitive strategy was to differentiate ourselves vertically as a low-cost, low-quality shoe provider. We lowered our price across the board, usually undercutting our competitors by at least $5. we're a low-cost producer because we've reduced the amount of superior materials, we reduced the number of models, and we had the minimum SQ rating. We also tried to decrease overhead costs by cutting the advertising budget, stop bidding on celebrities, and make small incentives for our workers. Last, we focused on the margins instead of the overall net profit.
Hey, this is Jeff, the CMO. We'll quickly talk about some of the positives from our change. As you can see, our scorecard was on a great upward trend, and we were able to increase our final score to 49 from a low of 20. We had positive financial results in all years, and we'll see a little bit of year 17 in a bit. We saved a lot of our costs by going to the lower SQ, of course. And we did have some issues. We saw in year 14 through 16 a little bit of a decline in revenue, which we did have an increase in year 17, as well as we increased some of our market share then, as we had had some issues with that. So we saw this great improvement in the scorecard. We had reversed the negative earnings. We had this cash reserve that we were going to try to buy back some stock, but we weren't quite allowed to by the game. And what we thought we did well, we took this big risk, made a big change, and we thought by analyzing the market, this was really our best and maybe only option. And we didn't have any issues with production. We didn't really anticipate some of the idea that competitors would do a similar strategy to us, and we had, again, the SQ and private label problems and fixed costs again and losing retailers. We definitely would move quicker. We would try to exploit private label better, keep retailers, as well as more attention to forecasting. Now in year 17, again, we were able to continue this upward trend. We were able to get our stock price all the way up to $32.57 from that low of $4.80. So we were really happy with the turnaround, and thank you.